Welcome to episode 72 of Accessible Finance. Special intro time. Let's go.
Yes. So before we really jump into today's episode, I want to take a moment to share something very personal. You may notice that I look a little different. And if you haven't noticed yet, you may soon enough. I am currently undergoing treatment for breast cancer. And we had debated whether or not to bring this up. But the truth is that life doesn't always go according to plan. Unexpected challenges are part of the journey. And whether we acknowledge them or not, they exist. So this experience has really only strengthened our passion to practice what we preach and to continue helping you navigate some of life's uncertainties. So today, our focus is on financial planning for life's curveballs, whether it is a sudden health diagnosis, an unexpected expense, or any event that kind of shakes up your financial future. We can't always control what happens, but we can control how we are prepared for it. So,
with that being said,
yeah.
Let's dive in.
All right. So, Eric, I think that the majority of people, when it comes to thinking about a big curveball in life, fall into one of two categories. There's a large group that tends to just kick the can down the line and say, we'll figure it out when we get there. And then there's the second group, which likes to believe that'll never happen to me.
Correct.
Neither one allows you to be prepared for when it inevitably happens at some point. Thoughts?
That's exactly right. So yes, we hear people do not want to insure for or prepare for low probability events. They're not particularly favorable to think about because the things that we're typically talking about are life insurance, which means you're meeting your untimely demise.
Yeah.
Or disability insurance, right? You can't work for extended periods of time due to some disability. That's not particularly favorable. Or, like a loss of a job or a divorce. Those are particularly expensive.
Yeah.
I hear and see. So, anyway, yeah, health issues, sudden loss of income for a job or something else, or a family emergency, you or a member of your family is causing you to take extended time off from work.
Correct. And we've talked as well about the fact that this sandwich generation is expanding. People are living longer. And we're seeing a lot of working aged adult folks caring for their young kids while now also having to care for their aging parents. And so the reality is that there are large financial impacts just kind of hanging on down the pipeline, whether you are caught off guard by a cancer diagnosis or some other emergency or unexpected event has happened. So how can you feel comfortable and at least have peace of mind before something happens that you've done what you need to do?
Right. And it's not just the financial impact. The psychological impact that these things are going to have is going to be catastrophic in some way, in some cases, right? It's hugely impactful, right? So
it doesn't go away. I mean, just speaking personally for us,
right.
I think that it's something that you continue to navigate because you go through the stages of grief and fear and denial and avoidance and like all of those feelings are there and you can't control them. And it's really, really difficult to think clearly and to think
100%.
Yes.
When you're in the moment, it's too late.
Yes.
Right? Like if you don't have a plan already in place, it's going to be very difficult to make calm, rational,
correct,
well-informed decisions.
There's no clarity.
Right. When you're undergoing this psychological stress and hardship and just turmoil, right? So
correct. Especially if you have kids as well or other people who are depending upon you to model how you're navigating this situation.
Mm-hmm.
The things that you can control ahead of time, just do it.
Right.
It makes everything else so much easier.
Right. And so one of the things we can do, right? We're not talking about insurance just yet, but one of the first things we can do is have an emergency fund.
Yeah.
We say it all the time. Almost every planner that you interact with is going to say you should have an emergency fund first. This is one of the reasons why, right? We can't know when an unexpected low probability outcome is going to occur. We just know that it could occur, right? And when it does, if you don't have the emergency fund, if you are not prepared, you're going to have a very bad time.
Agreed. And I think that when talking about the emergency fund, it's important to start diving a bit into what that looks like. And before we even get there, I do think it's important as well to know yourself as a person and know whether or not you're that person who sees funds in an account and can truly separate it as this is my emergency fund. I don't touch it unless there's an emergency. If you can't, you need it somewhere where you're not seeing it or treating it like this
I agree.
aggregate fund that you can access.
That's a good point.
We've seen that.
Right. Make a separate account. Make it a separate
Yes.
institution, right? You can have a separate high yield savings account,
Yeah.
at a different bank. You can have a separate, you could just make another brokerage account, just
Yes.
call it emergency fund.
And so
maybe
as you're talking like high yield savings and stuff, I think that we can dive right into like,
how
what
much
does
should
that,
it be?
Yes.
How
So,
much
okay.
should an emergency fund be?
Correct.
Typically 3 to 6 months of expenses. And we said it can be more. I don't think it would ever want to be less, but you could have more, right? If you're in a highly volatile industry, right? A good friend of ours, Greg.
Shout out to Greg.
Yeah.
Yeah.
He works with writers and
Yeah.
producers and people in the entertainment industry. And so their income is
Feels very
highly
feast or famine,
volatile,
yeah.
right? They could be working for a couple years and then be off for a year or more. And so their
Mhm.
emergency fund would want to be significantly more substantial than, a normal W-2. I say normal, but
Sure. Or just a W-2, right?
Correct.
If you are doing contract work or you're owning your own business or there's something where you can't necessarily predict what that income stream is going to look like month to month, you're on the upper end of that. Also, you like to talk about how many, nice.
We're on the pin. It's going to drop occasionally. That's how it's got to
The pen
be.
has to make an appearance in
It's
every episode.
Just how it is.
I do think that one of your favorite points to discuss as well is how many income streams you're dealing with.
2 income streams, 3 months, 1 income stream, 6 months.
Mm-hmm.
That's the typical textbook.
It's like a rule
that's
of
what you're
thumb,
gonna get,
right?
Yes.
Just because if something was to happen to one of the 2 income streams, you still have something coming in, right?
Mhm.
Okay, so we've talked how much. Currently, something people may be slightly interested in is your emergency fund is something that you need to access no matter what's going on in the market.
Correct.
And so if the market is currently on a 20% downturn, how are you protecting that emergency fund against that?
That's a great question. So I think we're 8% down today from the all-time high. Anyway, the point is, in periods of market uncertainty, like we're currently in, and probably will be when this airs as well, you're going to be, it's more obvious that this should not be in equities, right? Like emergency funds should not be in equities, period. Right. So what should it be in? We're thinking high yield savings account, money market
markets,
funds.
Yeah.
You could do laddered securities if you wanted to, or a very short term, bond ticker, something like that. Very short term fixed income investments, CDs. But you really ideally want to be able to put the money in and then get the exact same money out quickly when you need it.
Mm-hmm.
Right. And you don't want to be putting 10,000 in and then when I go to get it, it's 8.
Yes.
That is not acceptable. Right. You want the 10 and then you want to take some interest on top of it. And then that's your emergency fund.
Correct.
And I'm saying 10. I mean, 3 months of expenses, whatever it's going to be.
Because regardless of what the emergency is, or the curveball that's happening, it happens when it happens, right? Like I don't get to go to my oncologist and say, hey, I don't feel like paying this month. So it's right. I mean, you are stuck in the middle of it and you need the money immediately. And you need the value to be what you have in the back of your head as this is what I'm reserving for an emergency. Okay, so then we've talked about how much protecting it in a down market, and you kind of tangentially talked about the next question, which was just kind of where it should be housed.
Yeah.
Right?
Yeah.
So,
financial institution can be in a high yield savings account or a brokerage account that's invested in one of the securities that's mentioned. So
Perfect.
CDs or money market usually.
Okay, so let's say you've got that emergency fund. We're thrilled. It's enough to cover whatever has come your way, but now you've spent that emergency fund.
Right.
How do you go about replenishing that? Because the reality is that just because you got your first curveball doesn't mean you're now immune for the future.
We absolutely want to stay prepared, right?
Yes.
If you wanted to be prepared once, then you start when you want to stay that way.
Correct. It
So,
is best practice.
When we spend it, right? We're going to spend it at some point in time.
Correct.
We need a plan for replenishing it. If you have excess funds in your taxable brokerage account, right? If in taxable accounts, it doesn't have to be a brokerage, but if you have other funds and other savings accounts, you can simply move it to the emergency fund account, right? You could sell the securities, maybe I'm holding appreciated securities and that's not part of my emergency fund, but it is in a taxable account. I can take that and place it. I mean, I can make the sale, pay the gains or absorb the losses and then move the money, right? So you can transact. If you can't, then you're going to need to redirect your income stream. You're going to the most important thing is not exactly logistically how it's going to be replenished. It is that you have a plan to replenish it that is certain and will be achieved over time.
I think that's crucial. I think that your risk tolerance or your risk aversion is likely going to play in here as well, because you may be somebody who cannot sleep at night without having your emergency fund at least 80% replenished. So you're more willing to go and sell securities to have that sitting there. You may be somebody who's very comfortable with your income stream and you're willing to say, okay, I need 3 to 6 months. I'm going to divert X%. And in 6 more months, I'll have my emergency fund there again.
One quick point, I would try to replenish the emergency fund, if at all possible, in under about 6 months. We don't want to do like, we're going to divert $20 a month for the next 4 years, and then we'll have our emergency fund half filled, right? Like that's nonsense. We don't want that.
Exactly. I think that that's a really, really good.
No, this is important. We do this before we make other choices.
Correct. And And when we're talking other choices, we're talking even choices that are part of your financial plan.
Correct. Roth IRA contributions.
Correct.
And
529 contributions. Like, this is for the here and now and the things that we know are going to come at some point. So replenishing it or having a plan to replenish it within 6 months is critical. Beautiful. So, okay, next steps. And you mentioned this earlier. What about insurance? I think we have seen the majority of people, when they come to us with insurance policies, you've got your super risk averse people who are insured to the teeth, right? And we we look at some of the insurance policies, and we're almost kind of having to help them figure out like how we can fix some of them, because not all insurance is created equal again. And then we have people who are very averse to insurance or don't understand it. And are wildly underinsured or have no insurance. So what types of policies should we be looking at? What kinds of things should people be thinking about with insurance?
So you're going to need health insurance, right? Like, you're going to want to have a plan for that. And one of the ways this usually creeps up is if you separate from service, right? So if you retire maybe early, maybe pre-65, and you don't have a plan to either use your employer's COBRA coverage when you separate, or jump into the marketplace. You want to have an idea of what that's going to cost you. Make sure you can afford it. So that's part of the retirement picture. But essentially, at all points in time, you should have health insurance, and it should meet your lifestyle needs. If I'm young and healthy, maybe I want a high deductible health plan with an HSA, right? So I'm going to juice the HSA and I'm going to pay for my expenses out of pocket. That's one strategy to implement. If I'm, older or maybe just very risk averse and I want to, be part of some Cadillac plan where I'm going to have very high premiums, but very low out of pocket costs, make sure that's the case. Make sure that your maximum out of pocket is covered in your plan. Make sure you can cover that cost and it's not going to be catastrophic for you, right? If it is, then you might want to reconsider and think about what, the premiums might look like otherwise.
And when we're talking maximum out of pocket, you want to look at both your individual and your family. If you're looking at a family
Absolutely.
plan.
Look at the worst case scenario. Just make sure that that's something that you can handle.
That you can swallow.
It's not going to be something you're thrilled about ever, right? Obviously, but it needs to be something that you're not going to end up on the street as a result.
Correct.
So, and if it is, you've got to make sacrifices elsewhere, maybe, reconsider
look at other plan options, right?
You've got to make other.
And that's a really important thing, because you may not necessarily be thinking about that during your open enrollment period at work or whatever the case might be. And like you were mentioning, if you're transitioning, right? So I transitioned from my W-2 to working full-time with our company. So one of the first things that we looked at and started planning out was health insurance, and thank goodness for that. But it's so important to look at what plans meet the needs for your family.
Right.
Or you individually, if you're individual.
Right. So
okay.
That's not one that people tend to ignore as frequently, mostly because it's mandated since the Affordable Care Act on your tax return.
And most companies have it as part
of
it's
their
part of
the benefits package, right? But it is important. I will say this. It is important to evaluate health insurance as part of your total compensation package. Actually, we could do a whole episode on that, on how to evaluate compensation structures and
We
packages.
probably should.
We really should. I agree.
I'll make it.
But you need to look at your gross all in. You need to not just look at what paycheck amount is, because that varies wildly and
Yes.
oftentimes is not directly associated with your total package.
Especially if you're young and starting out, what you're looking at and
it's easy to be like, oh, I make $7,000 a month,
Yeah.
but this job's going to pay me $8,000. Maybe this is better, but maybe not is the point, right? Like maybe there's better matching at the $7,000
Yes.
a month job.
And you can go into
much better health
so
insurance.
much with like
So-
if there's
right.
an HSA plan, PTO, all of this stuff.
Right.
I'm going to make a note. I think that's a great idea for
Yeah,
an
sorry,
episode.
I'll go down the rabbit hole and never come
But
out.
yes.
So the other two types, right, that we'll talk about
insurance.
immediately, right? The other two
Mhm.
types of insurance that we'll talk about immediately. Disability insurance. Most people tend to think for the next two, really, it won't happen to me.
Yeah.
Why don't I just not worry about it? Well, there's also there's the incredibly selfish perspective of, hey, if it's life insurance, I'm not going to be here, so why do I care? I've heard that said before.
Yes.
Maybe not the most empathetic view, but it is a view, right?
And
I mean, that's
it
one way to look at
depends
it.
on if you're, flying solo or if you got a family.
Oh, for
as
sure,
well.
right? Like it's about your situation and your
Correct.
needs. Most people don't want to leave their family in dire straits, though. So the point here is these low probability events, like disability, right? That disability, just to be clear, involves the inability to work for prolonged periods of time,
Mhm.
and you can get coverage above the Social Security limits or what Social Security will pay. And then there's distinctions to be made there, right? There's any occupation, there's own
Yes.
occupation and any occupation, right?
Yes.
So the Social Security will pay out if you cannot do anything, right? That means not only can you not
can't
be
do
like a
any-
surgeon because
Right.
maybe I
You
broke,
broken your hand,
maybe I
yeah.
was skiing and I hit a tree
Yeah.
and I can no longer use my hands properly.
My doctor,
Maybe they shake now.
remember at our doctor's appointment, actually, our nurse practitioner told us that exactly that
Yeah,
happened.
two surgeons went on a trip and
Yeah,
both of them were hurt.
two surgeons in the department went on a trip. They went on separate skiing trips. Both of them ended up breaking hands, and neither one could perform surgery for an extended
Right.
period of time. So in that case, while you couldn't do surgery, you could likely still
Yeah, you might be able to answer phones or
Yeah.
work in another, you could do medical insurance
still
billing or something.
employable.
You could do something.
You're still employed.
The idea is Social Security is typically going to say, if you can do something, we're
Do
not going
that
to pay
thing.
you,
Yeah.
right? Whereas you can go get your own private disability insurance policies, or some companies offer this. You'll usually have to pay, but anyway, the point
Yeah.
is it's a group plan. You can insure for your own occupation.
Yeah.
So if I cannot be a hand surgeon, for example, right? Even if I have to go and do there's fine print on all of the policies and you have to go to an insurance broker. But the idea is disability insurance is a very good thing
Yep.
because when you need it, it's one of these things where it's too late when the accidents happen that put you in these spots.
And disability insurance as well tends to be one of the cheapest versions of insurance that you can get, simply because everybody kind of has the mindset of like, I won't necessarily need it. But like Eric said, a lot of workplaces will offer that as an add-on when you're doing your open enrollment. And so you're getting in at a group rate. And so the cost is pretty low. So it's definitely worth looking at how much it costs and if that peace of mind is worth it to you.
Yeah, and then real quick, life insurance. We've talked about this on maybe half the episodes, but just
Yeah.
very briefly, term life insurance is probably where you want to be for, I would say, about 95+% of people. Term life is completely sensible option. So yeah, term life, reasonably inexpensive. Get it when you're young, and that's when your need's going to be the highest.
Correct.
At the point in time you can self-insure, that's fine, right? So for all of these insurance, well, health insurance, again, we've talked about it's mandatory, and you probably don't want to self-insure that anyway.
Don't.
But the self-insurance version of health insurance is kind of a high deductible health plan with an HSA. But disability and life, you could theoretically self-insure, right? Like you could, if I have
Sure.
like $50 million in the bank, theoretically,
No,
like I don't really need life insurance because
Because I don't need to work.
right, I don't
Yeah.
really need to do anything anyway. So I'm not worried if I'm disabled, or I'm not worried if I have an untimely demise because my family will still be covered. So at the point in time, you can self-insure, and if it doesn't impact your plan, that's great. If it doesn't impact
Yeah.
your plan's viability, right? Like your family's financial success,
Correct.
long term, we're happy.
Now,
We're
this
not saying
presumes that
everybody
you
needs insurance.
have a financial plan.
Correct.
If you do not have a financial planner, you're not working with a financial planner, strongly advise against trying to or believing that you can
Mhm.
self-fund any of these areas. So, okay, Eric, we have hit on cash flow, cash replacement, emergency funds, insurance. What about estate planning? A lot of people really just kind of put this off
Right.
thinking I'm not old enough, I don't need to worry about it. Um Thoughts, general thoughts.
Please have one. Please have a will. Make this easier for the people that you're going to leave behind. They're already going to be going through an unfathomably rough time, right? Don't make them make other decisions on the spot when we've already talked about how they're not going to be in the state of mind that they're going to make the best decisions here.
Agreed.
So have a will, assign guardianship,
Yep.
tell people through your will, speak through your will, and essentially tell people what you want to happen. Don't make them guess, and don't let, the defaults prevail.
That's the biggest thing. I think if look into your state laws to see who would be in charge of making decisions for you if you don't have a will. It can be really scary. So if you have somebody that you trust that you want to be in charge of those things, communicate with them, name them, medical powers of attorney. There's so much that needs to happen. Set up an estate plan. All right. So now that we've addressed those issues, I think the very last thing before we kind of wrap it all up is kind of your tax and investment strategies for those funds to be able to kind of weather a financial storm that kind of hits.
Right. I think that if you're doing tax planning and if you're doing, the kind of financial planning that we're going to be talking about, that we do talk about on a weekly basis, you're probably fine, right? Like there's not a ton of additional steps to take other than, have an emergency fund in a taxable account where you can just pull it out without incurring huge tax consequences. But in this case, even if you are incurring this tax consequences, that might be the least of your concerns. The point though is you should have a Roth account.
Yeah.
Everyone should open it today. Open it with $100 and just keep one open.
Open it yesterday.
Right. So that you exactly. So that you've already satisfied the 5-year rule when you do need to make the qualified withdrawals. So anyway, have a Roth account. Contribute to the Roth account probably. Do backdoor Roths, that kind of thing, right? So that the idea is that you could take money. You can always take your contributions from a Roth IRA out, tax and penalty free.
And to be clear, these are just best practice things that should be done prior to an emergency.
That will make your life much easier.
Correct. In an emergency.
Unfortunate reality that you find yourself in when it happens, right?
Yes, an unexpected.
Correct.
Situation.
And then, one of the alternatives to long-term care insurance, because the premiums tend to make it not exactly cost effective anymore. They're being more, I guess you could say, like competitively priced or, fairly priced. They were actually quite consumer friendly at the onset. That is long-term care insurance policies. Now everybody needs them and they've kind of figured that out. So the price reflects that now in the premiums. You're not going to make out like a bandit, but something that people tend to do now is they'll pull some equity out of their homes. So they might have a high dollar primary residence, and you can take a HELOC or a reverse mortgage out and use that to that. Maybe you don't have to do anything preemptively, but when you find yourself in that spot, you'll at least know, hey, look, my plan is to pull some equity out of my house.
Well,
so now I know what I'm doing. I'm just going to the bank.
Exactly. Ultimately, it sounds like diversification of investments allows you to have a variety of options.
Sorry.
It allows you to have a variety of options so that when the time comes, you can make the decision that at that time is optimal for you. All right. So summing all of this up, like we've said, this is something that has hit very close to home for us. And we are fortunately in the position where we have been practicing what we preach. And so the financial impact is not something that we have really had to worry about. It's been all the other stuff we talked about earlier. And so to the listeners, I think it's crucial that we have a brief kind of gut check moment here. And I beg that you ask yourself, do you have an emergency fund? Have you reviewed your insurance coverage and insurance policies recently? Do you have an up-to-date estate plan or an estate plan at all? Do you have a financial team? Like, do you have a planner? Do you have a CPA? Do you have an attorney? Do you have somebody that you trust? Do you have family members that you trust? Going through any of this alone, I could never. I couldn't have. Sorry, speaking quite frankly, I just couldn't. So
yeah.
if Sorry, go
You all
ahead.
right?
Yep, I'm good.
Look, these situations are never fun, right? They could be a
It's
whole lot.
hard.
They will be a whole lot worse
Yeah.
if you don't have a plan beforehand,
Yeah.
right? And if you don't have the financial means to cover the medical expenses when they happen, and insurance, as you might expect, is incredibly fond of not paying for whatever they cannot pay for.
That's been the least fun part of this whole
right.
thing.
They're incredibly good at denying
Um,
claims. I mean, that's going to come as a surprise to exactly
Sure.
0 listeners.
But I will say, there's so much power in knowing what your insurance plan is.
Sure.
You're going to know better than the first few people that you talk to on the phone, and
Yep.
being able to advocate for yourself really well, or have somebody who you trust to be able to help fill that role, is crucial. So, finally, if any of these things that we just talked about gave you pause, the good news is that you can take action towards all of those things right now before something happens.
All right, guys.
All right. So again, if you want to talk through your financial safety net, make sure you're protected, you can visit us at equilibriumfp.com and set up a free consultation. Or if you have any questions or issues you want us to talk about, please email us at podcast@equilibriumfp.com.
That's right. We've got a listener question for next week. I'm excited to answer that one.
We do. It's coming.
All righty. Thanks,
Till
guys.
next time.
Thanks.